Welcome back to the Daily Crypto Roundup. Today we've got serious movement under the surface of the market, and it's not just price action. We're looking at a $12.5 million WLFI transfer that has traders watching key support levels, a 38% collapse in Robinhood's crypto revenue that could signal fading retail appetite, Bitcoin veteran Erik Voorhees shifting capital into physical gold, fresh Shibarium upgrades putting Shiba Inu back into focus, institutional investors calling for a complete rewrite of the crypto playbook, and Goldman Sachs warning that inflation could derail the Federal Reserve's rate cut path. This is one of those days where macro, sentiment, and positioning are all colliding at once. Before we dive in, if you're getting value from these daily breakdowns, make sure you're following the show so you never miss an update. We track the signals that actually matter so you don't have to filter through noise. Right now, Bitcoin is trading just under $66,500. Ethereum is near $1,930. Ripple's XRP is around $1.35. Binance Coin is changing hands close to $593. Solana is about $79.87. Cardano is around 25 cents. Dogecoin sits near 8 cents. Avalanche is trading at roughly $8.51. Chainlink is near $8.24, and Litecoin is close to $51.21, reflecting broad softness across the largest non-stablecoin digital assets as markets digest recent macro and sentiment pressures. Now zooming out to the macro backdrop, because this is where the tone of the market is really being set. Goldman Sachs is warning that inflation risks may not be fully resolved. Markets have been pricing in a relatively smooth path toward rate cuts this year. Lower rates mean cheaper capital, and cheaper capital supports risk assets. Crypto thrives when liquidity expands. But if inflation proves sticky, if the Fed is forced to delay cuts or keep policy tighter for longer, then that liquidity narrative weakens. And crypto, despite being decentralized, is still deeply connected to global liquidity cycles. If rates stay elevated, money flows toward yield-bearing assets, treasuries, bonds, defensive plays. Risk assets struggle to sustain rallies. Leverage becomes more dangerous. Volatility increases. This isn't panic, it's positioning. And positioning is everything. We're also seeing US equities extend a risk-on rally, which creates an interesting divergence. Stocks climbing while crypto hesitates. That tells you capital allocation isn't broad-based yet. Institutions may be rotating selectively rather than fully embracing digital assets. And that brings us to something even more telling. Robinhood just reported a 38% drop in crypto revenue in Q4. That's significant. Robinhood isn't just another platform, it's one of the clearest retail sentiment gauges we have. When retail traders are excited, revenue spikes. When retail interest fades, revenue drops. A 38% contraction suggests participation is shrinking, volumes are thinning, and speculative engagement is cooling. Retail historically fuels crypto momentum. They provide liquidity, they amplify trends, they chase narratives. When retail pulls back, markets feel it. This doesn't mean crypto is finished. It means the market is transitioning. Institutional capital has been entering over the past year, but institutions operate differently. They don't chase memes. They don't ape into volatility spikes. They demand regulatory clarity, liquidity depth, structured risk management. And that shift in capital behavior is one of the most important structural developments happening right now. Now, there hasn't yet been notable WLFI selling immediately after the transfer, but the market is watching closely. From a technical perspective, WLFI is now trading below a former demand zone, where the token had consolidated for months. That's important because prior consolidation areas often act as structural support. When price drops back below them, it changes the psychology of the chart. Traders are focused on a key support range between roughly 10.7 and 11 cents. There's also a cluster of leveraged long positions sitting in that region. If that level breaks decisively, you could see cascading liquidations. And when liquidation clusters trigger, volatility accelerates fast. That's how small-cap tokens can go from stable to chaotic in hours. The large exchange transfer combined with those long clusters creates a textbook volatility setup. If support holds, WLFI could stabilize and attract opportunistic buyers looking for a bounce. If it fails, downside pressure could compound quickly. This is one of those situations where the next few sessions will tell us more about broader appetite for smaller cap risk. Now zooming back out, because this ties into the bigger theme we're seeing across the market: sentiment fragility. Bitcoin veteran Erik Voorhees has reportedly liquidated a portion of his crypto holdings to purchase physical gold. This isn't a random retail trader. This is someone who helped shape early Bitcoin ideology. So when a long-standing crypto advocate adds physical gold to his portfolio, people pay attention. This doesn't mean he's abandoning Bitcoin. It means he's diversifying. But the symbolism matters. Gold and Bitcoin are often compared as stores of value, but they're rarely bought side by side by hardcore crypto insiders. When someone strongly associated with the digital gold narrative moves capital into actual gold, it highlights a shift toward hedging and capital preservation. It reinforces the idea that even high-conviction participants recognize macro uncertainty, inflation risks, rate uncertainty, liquidity tightening. Diversification becomes logical in that environment. Conviction doesn't mean exclusivity. It means disciplined allocation. And that disciplined theme keeps surfacing. Institutional investors are increasingly vocal that crypto must be approached differently from retail speculation. Large allocators can't operate on Twitter sentiment or meme momentum. They require liquidity depth, regulatory clarity, and measurable downside controls. The more institutional capital enters, the more the market structure gradually shifts away from pure hype cycles. That doesn't kill upside, but it slows the boom-bust reflexes. Meanwhile, Shiba Inu is quietly creeping back into focus thanks to upcoming Shibarium upgrades. This is interesting because Shiba historically moved on pure community energy. Now the narrative is gradually pivoting toward infrastructure and utility. Price isn't exploding, but it is holding above key psychological levels. Support zones have been defended multiple times, suggesting holders aren't rushing for the exits. If Shibarium upgrades deliver improved throughput, lower fees, and real application usage, then the narrative shifts from meme to ecosystem development. And when narrative aligns with tangible network improvements, momentum can build more sustainably. Traders watching SHIB are looking at both technical structure and network activity metrics. If user engagement rises alongside price stability, that's when accumulation phases can begin. If upgrades disappoint or fail to attract real activity, momentum fades again. So this one becomes a catalyst watch rather than a pure speculation watch. And all of this is unfolding while US equities extend a risk-on rally. That's the macro test. Crypto traders are essentially being asked, are you following stocks higher? Or are you hesitating because liquidity conditions remain uncertain? If inflation persists and the Fed delays cuts, liquidity tightens. If liquidity tightens, speculative flows slow. If speculative flows slow, smaller caps feel it first. That's the environment we're navigating right now. So what's the takeaway? Retail participation is cooling, at least temporarily, evidenced by Robinhood's 38% revenue drop. Institutional capital is demanding structural discipline. Macro uncertainty around inflation is back in focus. Smaller caps like WLFI are testing fragile support zones. Meme ecosystems like Shiba are attempting to transition toward infrastructure relevance. And seasoned veterans like Voorhees are hedging with gold. This isn't a euphoric market, it's a selective one. Bitcoin and Ethereum continue to function as liquidity anchors. Smaller tokens are highly sensitive to positioning. Macro narratives are driving short-term volatility. And capital is moving cautiously rather than aggressively. The key in environments like this isn't emotional reaction, it's awareness. Watch liquidity, watch support levels, watch inflation data, watch exchange flows. Because those are the signals institutions use before retail ever notices. We're not in a collapse, we're in a recalibration phase. And recalibration phases often precede the next major directional move. But only after weak hands are shaken out and positioning resets. That's what we're watching now. It's going to be a tough period, but remember why you are here. Keep your conviction, and only sell if you are doing it for the right reasons. Drop your thoughts in the comments, smash like, follow the show, and as always, we will see you at the top.